Hey, what's up, my friend? So, over the last few years, right, there's a ton of SMC traders popping up on YouTube. Yeah? So many confused traders on YouTube. So, let's clear up some of the confusion by bringing you back to the original source material. Yes, right, the SMC concept, otherwise known as the smart money concept, isn't anything new. In fact, the strategy, the concepts, the techniques, right, have been around for a long time, some even as long as 100 years. Yeah, but given a new name, a new spin, a new flavor, right? So in today's video, let's tackle a few of these smart money concepts, namely the liquidity sweep, the order block, the fair value gap. Yeah, and I'll explain what these concepts are, and more importantly, where these concepts originate from. So if you're studying SMC, the smart money concepts, but still not seeing the results that you want, then you should consider studying the source material, which I'm about to share with you in this video. Let's go. Okay, first, let's talk about the liquidity sweep concept. So it looks something like this. Okay, so for those of you who are not familiar, let's say the price goes up, comes back down lower, goes back up, price take out this highs and then reverse down lower once again, usually closing below resistance, closing below this swing high. Now, this is how it looks like, but the more important question is why? Why does this happen? Okay, and this is where most people will not talk much about it, because you need to understand market microstructure to know why this happens. And I actually learned this from this trader called Trader Dante. Okay, so why this happens, right, is because let's say the market goes up higher, it makes a pullback and goes up higher once again, and let's say just for illustrations, let's say it comes back down lower once again, and now it's going back up higher once again. So at this point, you can see that over here, above this highs, or above resistance, whatever you want to call it, there are traders who are short, right? Because technical analysis, if you study it, you will learn that when the price comes to resistance, you should short, right? So there are traders who short. And where do they put their stop loss? Well, probably they have their stop loss above these highs, above these highs. So what this means, right, is that if traders who are short and their stop loss is above these highs, this is in essence buy stop orders. Okay, because if you are short and you place a stop loss for that short position, it's actually a buy order to get you out of the losing trade if your stop loss is triggered. So when there is a cluster of stop loss accumulating above these highs, this is what we say there's an accumulation of orders, accumulation of liquidity above these highs. So let's say institution, someone with deep pockets, he knows that there's this cluster of buy stop orders over here. So what can he do? What he could do is he can push the price up higher, right? Let's say he buy at this price point, this institution, right? He buy at this price point, okay? And the price, he keeps pushing up higher, and hit this cluster of liquidity over here. And when this cluster of liquidity is hit, what happens? Well, if you recall, it's actually buy stop order. So this means, right, those traders who are short, they are now scramble to the market and exit their trade. In other words, they are hitting their stops are getting hit and they are actually buy stop orders. So what this institution does, who bought earlier, he's going to sell his position into this cluster of buy stop orders. And this way, when he sell, he will not be moving the market. He's going to get filled on his trades, right, from this group of traders getting stopped out. Because imagine if, let's say, this buy stop orders, let's say it wasn't there. If this institution were to hit buy and then if he's going to sell, if there's no one taking the opposite end of his position, right, what's going to happen is that he's going to be pretty much moving the market. But now that he knows that there is a cluster of buy stop orders above these highs, he can sell into this liquidity, right? And when he sells into this liquidity, when there's no one left to buy because all these buy stop orders are filled, or maybe there isn't any more buying pressure coming in to push the market higher, what happens? That's when the market pretty much goes up, take out the highs, and then reverse down lower. Okay, so that's what we call a liquidity sweep, and that's the reason why it happens. So now, just to walk you through a few examples, right? I simply just plucked this off from Google. Okay, you can see this one over here. Price, you can see over here, it goes up, take out this highs, right, and then kind of like reverse down lower. Okay, another example here. This is taken from YouTube. Again, I just Google and this one just pops up. You can see over here. This is the highs. price then take out the highs and then reverse down lower from here. Now, the important question now is this: where did this concept originate from? Okay, and this brings me to this gentleman over here. This guy name is called Richard Wyckoff. He's, I think, from what I found on Google, 1873 to 1934. So he passed away, I think, almost 100 years ago. Okay, he's the creator of this method called the Wyckoff method. And why am I saying he's the originator, or rather the so-called founder of this liquidity sweep concept? Because if you look at his works, right, notice this. Okay, so you can see that he actually came up with this concept called the 4 stages of the market: accumulation stage, breakout, uptrend, and distribution, etc. And where I want to point to you is, like, notice this. Look at this. This is what he called the spring. Does this look familiar? So what the spring does is that you actually take out the lows of resistance of the range, right? Once the spring happens, and then that's where price usually heads up higher. This is what Richard Wyckoff calls the spring. Okay, and the upthrust is just the inverse. Okay, so you can see over here, this over here is what we call the upthrust. Why is this an upthrust? Notice the highs over here and here. Price makes an upthrust above the highs and then reverse down lower. Now think about this. Does the spring and the upthrust look familiar to you? And by the way, this concept of the spring and upthrust is about 100 years ago. It's nothing new, right? It's actually, I pretty much would give credits to Richard Wyckoff, who actually came up with this concept. So yeah, this is pretty much where the liquidity sweep concept originates from. If you ask me, it's from Richard Wyckoff. Next, let's move on to the concept of order block, right? Another smart money concept that you would probably, have heard many times. So this over here is taken from Baby Pips, right? So for aspiring forex traders, Baby Pips is a great place, right, to learn more about forex trading, and they have like a definition of an order block. So have a read, right? It says over here, an order block is an area where there has been a large concentration of limit orders waiting to be executed. Order blocks are identified on a chart by observing previous price action and looking for areas where the price experienced significant movement or sudden changes in direction. Now, I have an issue with this paragraph. Okay, I'm not sure who wrote it, but if you think about this, right, this seems to contradict, right, between the first and second paragraph. This one over here with this one over here. Why is that? So if you look at this, right, an order block is an area where there has been a large concentration of limit orders waiting to be executed. Okay, and order blocks are identified on the chart by observing previous price action and looking for areas where the price experienced significant price movement. So here's the thing. So is an order block an area on a chart where there is a ton of limit orders waiting to be executed, or is order blocks on the chart, right, where significant price movement has occurred? Okay, and by the way, right, on a chart, you can't see the amount of limit orders that's being placed by looking at charts. You need to look at the order flow of the market, the depth of the market, right? You can't look at charts because, let's say for example, you look at any candlestick chart, maybe the 5 minutes time frame. You place 100, lots of Euro USD, let's say with your brokerage. Do you think, you place 100 lots of, buy limit order on Euro USD. Will the candle on your 5 minute chart change? It won't, right? Because when you place limit orders with your broker, it will not reflect any changes on the chart, right? Changes that's being reflected on the chart only occurs when the transaction has occurred. Okay, so this one over here, right? So this got me a little bit of confused. I can't really quite understand, right? How order block is an area when there's a large concentration of limit orders waiting to be executed, because you can't see this order block on the chart. You only can see it by looking at the depth of market, right? They call it the DOM, right? DOM, right? The depth of market. Okay, or level 2, some people call it, right? You can't see it just based on charts. And then the second statement over here says that, order blocks are identified on chart by observing previous price action and looking for areas where price experience significant movement. So in other words, right, if you ask me, my first thought is support and resistance. Okay, so anyway, right, let's have a look at a few examples, right, that I found on Google, and you can have a look at it. So this one is from FX Open. Okay, so this according to them, right, you can see it's a bullish order block. This is a bearish order block. What does that look like to you? Well, to me, it looks like support and resistance. How about this one over here? Oh, well, this is quite interesting. This is from Trading with Rayner. Not sure who that is, but I heard he's a pretty smart chap, right, from what I've heard. So he calls this area of support on the chart, but which looks kind of similar to the order block, right, which I shared with you earlier. So again, right, so yep, this is an area of support according to Trading with Rayner. So by the way, did I invent the concept of support and resistance? Of course not. I didn't invent it. I pretty much learned it from other veteran traders, people before me, right? I think if I were to give it credit, where I first learned the concept of support and resistance is probably from this guy called John J. Murphy from his book, Technical Analysis of the Financial Markets. And John probably learned the concept of support and resistance from someone else. I have no idea who, right? So you can see that the concept of support and resistance, just like the upthrust and the spring, has been around for decades or maybe even centuries, right? So nothing new under the sun. Now, some of you might be thinking, but Rayner, order blocks must have a series of blocks on the chart. That's why we call it order blocks. Must have a series of bars on the charts. That's what we mean by order blocks. Okay, if that's the case, right, then this man over here is probably where I would give him credit, right, for that concept, right? So this man over here, his name is called Sam Sadin, right? He's the creator of this concept called supply and demand. So he got into trouble with the law some time back, but again, well, we won't talk about that case because it's irrelevant. But what's relevant over here is that the concept of supply and demand, right, looks something like this. Okay, so this over here, you can see that he pretty much defined support and resistance into more nuance, right? So he has this concept called, for example, 4 different concepts. This is the, oh, it's so dark I can't see, rally base drop. So pretty much you can see the price makes a rally over here, it forms a base, and then it drops. Okay, so some people might call this an order block, right? So his concept is for supply and demand people, they call this rally base drop. Then of course you have rally base rally. So price makes a rally, forms a base, and then rally. This one here, drop, base, and rally. So if you were to look at this, right, and some of you might even argue, hey Rayner, all this looks like order blocks, order blocks, order blocks. And guess what, right? This concept of order blocks probably would originate from this concept of supply and demand. Okay? So if you want to go back to the source material, I would say reference, look at support and resistance, or even supply and demand. Moving on, let's talk about fair value gap, right? FVG, fair value gap. Okay, so what is it and how does it work? So fair value gap, right? How it works is something like this, right? Let's say the market goes into a range like this, okay? Then it's a pretty strong breakdown, right? Bearish candle, okay? Then this is what we call a fair value gap, right? The price gapping away from this fair value over here, and depending on which traders you follow online, some will say, look to sell at this level. Some will say wait for the price to go back into the range to sell. So again, depending who you follow, and there's quite a few different school of thoughts, and I have a little bit to talk on that, right? Why there are different school of thought, right, when it comes to the SMC concepts. But for now, this is what fair value gap is about. And if you look at some examples, again, I just plugged this off from Google. Okay, so this is from Reddit. You can see over here the fair value gap, right? Price over here is in a range, so-called fair value, then boom, right? Massive, huge red candle causing this gap over here. So that's what they call a fair value gap. Okay, another one here. Again, similar concept. Here is the fair value, price then breaks down lower, creating this fair value gap. So now, where did this concept of fair value gap originate from? So if you ask me, right, I would give it credit to this person called J. Peter State. I hope I pronounce his name correctly, right? So he's the creator of this tool called Market Profile and Volume Profile. And again, if you're not a scalper, if you're not a short-term trader, you probably would have not have used this tool like Market Profile and Volume Profile, because these tools usually require they're premium tools. Usually need to pay money to access these tools. Right? Most retail traders will just trade off charts, right? Free charts, especially MT4, TradingView, etc. Usually they won't use such tools. Right? I've actually first come across this tool when I was a prop trader back then, trading the Japanese futures market. That's how I learned of it, and that's how I learned of this person, right? Peter State, because back then as a prop trader, one of their, I won't say requirement, but they tell us to not rely so much on charts, learn how to read the order flow, the depth of the market, right? And use that to, time your entries and exits. So they encourage us to not look at charts at the start, right? Rely on using the order flow, the volume profile, learn what is it, how it works, right? And that's how I got first exposed to it. So what this is about is that this concept of market profile and volume profile, let me just explain to you. They have this concept called the value area. So let me explain what this means. So you can see over here, the value area is the range of prices where 70% of the trading activity occurred during the session. So in other words, right, where the price have spent majority of the time at, that's what we call the value area, which is, in other words, right, if I were to draw it on the screen, it looks something like this. Let's say price goes up, then start to go into a range, right? Most of the time spent ranging, right? This is what we call the value area. Does that look familiar? Does that sound familiar? Okay. And then this one takes a step further. They have this thing called the point of control, the POC. This is the price level with the highest volume transacted during the session, because this is what, according to market profile, this usually acts as support and resistance on the chart. And by the way, again, depending on your charting platform, you may or may not be able to find this POC right on the chart. Yeah, again, maybe TradingView has certain indicators that help you find it. I'm not sure about that. So over here, just to illustrate, you can see over here, this is the value area. Notice, right, the entire trading session, let's say, is from here all the way to here, right, from start to end. Most of the time, you can see over here, the price is spent ranging over here. So this is what we call the value area, because about 70% of the time, you can see the market is spent ranging. So you can see over here, you can actually have this appear as a, a histogram, yeah? And the POC, the point of control, is this over here, the most extreme bar over here, the most extreme bar, which is this. Okay, this is the red one, I think they highlighted. The longest one, this is what we call the point of control, because this is where, at this price point, the most number of transaction has occurred. They call this the point of control. So you can see over here, probably somewhere around here, based on this chart, yeah? So if you look at, let's say, okay, value area, okay? So when someone says, right, a fair value gap, right? If you think about this, this is in essence a move away from the value area. Do you agree, right? So over here, back to the example of the FVG, right? Fair value gap. This is in essence a move away from the value area. And as you've learned, right, the value area concept pretty much originate from this person called J. Peter Stegmaier. Hopefully I didn't butcher his name. If you're watching this video, I do apologize in advance, right? Your name isn't the easiest to pronounce, or maybe I'm Asian, right? I butcher every Western name that I come across. Okay, so here's the thing, right? So this over here is the fair value gap. But again, if you ask me, it pretty much originates from market profile and volume profile. So where do traders then enter on this fair value gap? So many traders will tell you that, you would, enter this pretty much wait for a retest, let's say of this over here, previous support that could become resistance, right? It sounds familiar again, right? Where did that originate from? Okay, or some could tell you, say, wait for the price to go back to the middle of the range, or some even more conservative tell you to wait for a retest of this area of resistance over here. So yeah, these are all different levels where different SMC traders will tell you where they will look to enter on this fair value gap. If you think about it, it's just simply a breakout of a range and retest back previous supports that could become resistance. Is this concept anything new? Nah, it's been around for ages, and you really want to go back to the source material of this value area is from as I've mentioned and butchered the guy's name many times, Peter Stegmaier, right? J. Peter Stegmaier, yeah. So okay, so yeah, this is just kind of like pretty much the two slides I shared with you earlier. Next, right? So if you ask me, right, where does the concept of this fair value gap originate from? Again, check out this guy's work, creator of market profile and volume profile. I believe he has written a number of books. You just do Google, you can pretty much find his books. And in my opinion, those are really more relevant for short-term traders, intraday traders, scalpers, those who really make a lot more sense. I'm largely a swing and position trader. I don't use these tools myself, but hey, I do not know what stage of your trading journey you're at, right? So those might be beneficial for you if you want to dive into more details. Okay, now at this point, right, some of you traders might be thinking this, right? But Rayner, these examples that you've just shared, these are not the real smart money concepts. Guess what? The examples that I've shared with you earlier, I've taken it all from Google across different sources. As you've seen, right, we have taken it from Baby Pips, FX Open, TraderRate, TrendSpider, all these different trading resources out there on the internet. And if you can't agree that they are correct, then it means a few things. Number one, it means that smart money concept, the SMC concept, is subjective and open to interpretation to different traders. And number two, different traders will then add their spin and flavor to it and still call it smart money concept, because that's what, you know, get them a ton of views on YouTube. Yeah. And finally, number three, in a world where 95% of traders fail to make money consistently in the long run, you have pretty much the blind leading the blind, right? And each claiming, right, that theirs is the real SMC smart money concept. So looking back right now, I just realized what is the real meaning of SMC. So much confusion. And if someone were to tell me, man, Rayner, I'm an SMC trader, it tells me that there are so many confused traders. Yeah, so if you're one of the few traders, right, who have, you know, used smart money concepts and it has worked for you, great, right? You know, give yourself on the bet. I'm pretty sure you've done a lot of hard work, right, to validate these concepts for your own trading. But if you're the majority of the other traders who have, you know, tried all these different strategies and techniques and still have not found something that works for you, then my suggestion is go back to the original source material. In this video, I've, you know, shared with you where I believe are the original source material from. Go and study their works, their books, right? Understand how it works, why it works, right? And use it to build your foundation. Not build your foundation based on other people adding their own spin and flavor to whatever concepts and then making it their own, and then you learn from it. You don't really understand the why behind it. So go back to the original source material, use it to build a stronger foundation, and hopefully, right, this, you know, helps you become a better trader. So that's all I have to say for today's video. If you've enjoyed it, right, smash the thumbs up button as usual, hit subscribe, and I will talk to you soon.